Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today we are going to talk about Jackrabbit TV and an update that I made within the DCA module and the analyzer. So let's get straight to the chart. I have it zoomed in to a particular area that is extremely frustrating and annoying. Now, the market does obviously recover from historical data, but when you're dealing with live data and you don't know the outcome of the market, this is absolutely frustrating to no end. When the market is just almost there, but not quite, and you don't get the transaction or the sell. This is a case of just close enough. And that really is the point. The price is close enough that I'd wish the blasted thing would have taken it. That is what my most recent update addresses, where the situation of being close enough matters. In this case, we see it didn't take the trade. It didn't get out of the market, and it took more accumulation. Now, that could be a bad thing if the market just decides to drop extensively. It could be a good thing if the market recovers, such as what this one will do eventually. But as you can see, it takes on an accumulation and it just keeps dropping. Now, the accumulations, of course, do well and they will profit. But what if you want just to accept close enough? What if you want to say, okay, what mechanism can I just take this? It's close enough. I'm happy with it. Well, the update that I posted recently does just that. So let's go down. As you can see, 1.5% deviation, 2% take profit. We are closing on the wick, so the wick crosses the line. In other words, I want a defensive take profit that gets me out of the market as quick as possible. I can use close, but I'd rather trigger on the wick and try to catch as much as I can. And of course, how I have my strategy and the recent addition to Jackrabbit DCA and Analyzer. Is close enough good enough? Well, in this case, for my particular risk assessment, yes, it is. I wanted it to take this exit. So I can turn this on. And now I pick how close is close. So let's go with 0.1%. And let's see what it does. As we can see, it checks red candles. That is, if the candle is moving away from my take profit. This is a long position, so here the red candle is what is moving away from my take profit. If it was a short position, then it would use the green candle. 0.1% isn't close enough. What about 0.2%? It's still not close enough. What about 0.3%? It is close enough, and I got out with the profit. Now, the issue behind this is really a complicated one, because it deals with your risk appetite and your risk assessment. If you're trading something you don't mind holding, then this is not a good practice. In other words, if you want to hold the asset no matter what, don't use this technique. But if you're trading an asset that is not one of your favorites, but it is good performing, then this could be a good way of mitigating additional risks while still capitalizing on whatever profits you are able to take. So close enough is a situation that really is fear of getting out of the market too late. For example, if you end up with a situation where the market just pummels downward and could take 3 months, 6 months, or even a year to recover, close enough in this kind of a market is good enough. And that really is the whole point of this technique. It's one additional layer you can add to your strategy to help you improve your trading techniques. Now let's see what this looks like at the end of the road. In other words, let's go to the end where we see the statistics. How does close enough affect your actual profit? Well, we see here we have an average of 2% with 8 trade cycles. We have an average of 3 purchases per cycle with a maximum of 7. So let's see how close enough affects this situation. Is it something that should be a consideration for our trading? So let's go back to 0.3%. And it gave us an additional trade, closed out, and 1.7% is the average. So we lost 0.3% total of the average, but we gained an extra trade. Is that trade-off worth it in this circumstance? That is close enough, good enough to keep us in the green? Only you can answer that in your own personal risk assessment. There are a lot of circumstances that can affect this kind of decision, and really there's no right or wrong information or direction to go. The one thing that must be emphasized, as long as you're making a profit, you have beaten 90% of the people in the market because they don't make long-term profits. Understanding when to get out of the market is absolutely critical. Could the market go up and you get 5,000% return? Yes, it could. But if you have a high risk already, is it worth the potential of getting liquidated for that possible return? Probably not. It's these kind of decisions that make trading difficult. It's not the idea of whether or not you can make money. It's the idea of whether or not you're going to keep what you make. And that really is the paradox of trading. Keeping what you make is a difficult assessment because there's no guarantees of what the market is going to do. And one of the biggest issues you're going to run into when you're testing your strategy and you're looking at these pretty little charts is that they all look great in back testing. That is, you can see all the wonders of how the market will work and whether or not it will recover. The problem is this doesn't translate in a market where you can't see the future. And nobody can see the future. That's the problem. Realistically, from the standpoint of your trading, We could even look at another situation. Let's take this one right here. How close is close enough, and is it worth the difference of profit? So let's zoom this in. We can see right here the market went down and it just kept on going down. But from the standpoint of our trading, we don't know what's going to happen. Will this market recover in a live circumstance? That is something to be considered. So let's see how close enough is in this circumstance. Is it worth accepting a lower profitability just to get money off the table and in the bank? We're at 0.3. What happens if we go to 0.4? How does that change? Okay, 0.5. How does that change? So 0.5% later, it's not close enough. So that's kind of one of those situations where if you want to get out of it, if your take profit is 2% and you're willing to sacrifice 1% just to get out of it, is it worth it? It might be. In this case, we can see we can probably go with 0.9. How important is evaluating risk in your strategy? That really is the most difficult circumstance you have to ask and assess. If your risk can handle the positions, then you're fine. If your risk can't handle a large number of positions, such as a smaller budget, then you're not fine. But any profit is better than losing all of your profit. And as we can see, it does affect our total profits. But 1.38% at 12 trades is still a respectable amount, and it is still more than our fees. So in this case, having this type of an extreme situation drastically lowers our max buys, and it significantly lowers our average overall. So for me, for my risk assessment, this would be a considerable possibility that I would leave on the table. I would accept this as close enough given how unstable this market is and the fact that I don't want to be in it long term. I don't want to be trapped. And that really is the whole point of the market. Close enough is a paradigm of not being trapped. So we can see this is pretty easy to manage. So by simply looking at the possibility of being willing to accept a slightly lower amount, we can drastically reduce our risks. Now, if the market is going upwards and in a green candle, for example, like this situation here, could we have gotten more money? Yes. Is the risk worth what the possibility could be of not being certain? Maybe, maybe not. Always evaluate your personal risks appropriate to your own financial situation. Close enough is a tool designed to help you. It's not perfect. Nothing ever is. But it's designed to give you a way. In this case, we could have squeezed more out of the market. But is it worth the risk of chasing profits just to lose more than you've gained in the long run, or to be stuck in a situation where you might not be able to get out of the market for a longer period of time? All of these considerations must be taken into account carefully and deliberately. Please ask questions, leave a comment. Is this something that you think would help you? For example, here are another case of where close enough was good enough for this circumstance and it got out of the trades a little early. It would have recovered over here, yes, but you don't know that. And that's the problem of backtesting. That's the illusion, the lie, the delusion of what backtesting represents. It gives you a false hope that may not really exist in a real world market. Take time to evaluate in a realistic way what is appropriate to your risk management and budget management methodology. Money doesn't do you any good if you take unnecessary risks, because you're not making it, you're losing it. If it costs you $2,000 to make $1,000, you're going nowhere fast except bankrupt. And that's the whole point that many traders miss. You need to balance your trading appropriate to your risks. So ask questions. Let me know, would this technique have helped you with some of your trades? How many trades would have benefited from just being able to accept a little less than what you asked for? If this video has helped you, please hit that like button. If you're not subscribed, please subscribe. Please help me grow this channel so I can continue to provide this kind of information and tips to help you improve your trading. And if you would like access to these indicators, please subscribe to my Patreon. I'll put the link below in the description. Thank you for watching.